John Bellows, everyone has an opinion as to when the Fed is going to hike rates. What's yours?
We think the Federal Reserve would very much like to hike rates in September. They view zero interest rates as an emergency policy, but we're no longer in an emergency, so they want to get interest rates up. They're just waiting for the economic data to justify that. We think the economic data has been better as of late, and should that continue, the Federal Reserve will increase interest rates in September.
So with that in mind, where's the best place to be along the curve right now?
You know, what's interesting is even though we expect interest rates to increase in September, the market seems priced for a somewhat later hike. So the market seems priced for a December hike and then seems priced for an extraordinarily slow increase in 2016. So we agree the increase in interest rates will be slow and gradual, but perhaps not as slow and gradual as the market expects. I think that makes the front end of the yield curve somewhat vulnerable. And so as a result, we prefer the back end of the yield curve. We think there's more value there. We think it's a better diversifier for some of the risk assets, and it's also less vulnerable to Fed hikes.
Are you finding value in high yield right now? A lot of people say it's very toppy and they're worried about high yield getting slammed.
You know, we do think there's value in high yield spreads, so the yield relative to treasuries has widened since the middle of last year. We think that's an opportunity. Look, when the Federal Reserve hikes interest rates, they're not going to want to disrupt the economy. They're not going to want to disrupt financial markets. And if we're right about that, then we think high yield can continue to perform well. Investors continue to earn that extra return. And we think that's a place that you can actually add value in your portfolio even as the Fed is hiking.
All right, so what risks may lie in people's fixed income portfolios? And I'm not talking about holding a Puerto Rico or a Chicago bond that might have problems. What are you scared of out there?
You know, I think the primary risk for a fixed income portfolio is inflation moving up sharply. If inflation moves up sharply, that obviously increases yields. That would make the Fed somewhat more aggressive in their tightening, which could slow economic growth and is generally very challenging. However, I want to emphasize we don't see that as a coming possibility. Sure, it's a risk, but we think there's long-term secular headwinds for inflation, reasons why inflation is going to remain low. And so going forward, we think inflation is likely to remain at these low levels with risk to the downside, not the upside.
And then finally, if someone wants to get a little bit more yield, are foreign bonds a good place to go? Maybe emerging market bonds? Or is there worries that when the Fed does finally raise rates, it's going to hurt emerging markets even more?
You know, I think you're exactly right that there are worries about that. I think the consensus is that when the Fed hikes interest rates, it will be challenging for emerging market bonds. Investors cite turmoil in 1994. The Fed hiked rates in February, and Mexico had a currency crisis in December. So there is precedent for that. However, we're somewhat more optimistic for emerging markets. We do have emerging market bonds in our portfolios. The yield advantage is significant with Mexico bonds at 6%, Indian bonds at 8%, or Brazil at 12%. That's a significant yield advantage that will add value. And the fundamentals in emerging markets are starting to look a little bit better. The People's Bank of China has been easing aggressively. They're supporting their economy. The bounce in oil prices helps. And you've also seen meaningful structural reforms in places like India and Mexico. So I agree the consensus is bearish on emerging markets, but we find ourselves somewhat more optimistic. And as a result, we have emerging market bonds in our portfolios.
All right. Thanks a lot, John.
Good. Thank you.